Welcome back. The Reserve Bank has kept the repo rate unchanged at 8.25%. For analysis on this, I'm joined via Teams by Nicky Weimar, Chief Economist at Nedbank, and Arthur Kamp. He's Chief Economist at Sanlam Investments. Thank you very much to both of you for joining us. Ladies first, Nicky, let me come to you. I think that decision was largely expected, but what sense did you get from the kind of talk that he was giving us behind the scenes? It sounded like a still very hawkish speech to me.
Yeah, I think it was in line with everyone's expectations. I don't think there were too many people that expected a cut or a hike. So most of us expected them to stay put. And we also, in general, expected them to continue with the hawkish rhetoric. And I think there's a lot of reasons for that, but it mainly relates to the fact that you do have certain risks. We think they're starting to recede a little bit. They're not as acute as they were earlier this year, and certainly not as bad as they were last year. But nonetheless, I think it has a lot to do with those uncertainties, especially around oil and food prices. And then just generally speaking, who knows what's going to happen to load shedding? Who knows how Transnet, the road and rail and port issues will play out in terms of cost structures and companies' pricing decisions. So all of those uncertainties, and they are genuine uncertainties, I think is what's contributing to the hawkish rhetoric. But for me, the key here is that it was a unanimous vote. And that's the first time we've had that, right? It's always been split votes. There's always been members of the committee that still supported further hikes. So I think the fact that it's a unanimous decision to leave rates unchanged is suggesting that we're probably at the peak in the rate cycle.
Yeah. Arthur, one of the areas that the governor touched on was food inflation, expecting it to remain quite elevated at around 10.6% in the year 2023, but it comes down quite substantially next year. So what's going to change between now and next year?
I think the key thing is base effects, really. So you're still expecting food prices to go up, but just at a slower pace, because you've had some shocks and they tend to increase food prices quite quickly initially. And so all you're really expecting is that those prices will probably continue going up next year, but at a slower rate. Provided, of course, that they're not additional new shocks. The governor did point out that El Nino is lurking in the background. We don't know what the impact of that would be. We live in a world where, given the current environment, you get these shocks like floods and droughts and all sorts of things happening. Makes it very difficult because, as the governor pointed out, very large component of the overall CPI basket. So it's, and on its own, I mean, obviously when we look at food inflation, I think the governor was also clear that the bank looks through temporary shocks. So in part, this is a supply side shock we are seeing with some of these food prices. And so the committee looks through that. But I think what it would be wary of is if there were to be second round effects coming through. For example, if I look at the lower income deciles, the inflation rates there are above 8%. A lot of that is food price inflation. It could result in higher wage demands. And if that were to be the case, that potentially you start getting second round inflation effects. I must stress, however, that there's very little indication of that at the moment. I found it interesting that if you look at the statement that the average sort of salary expectation for this year was actually revised lower from 5.4% to 4.6%, and next year is expected a little bit higher than previously. It went up from 5.9 to 6%, but really at the moment, in real terms, people's wage growth is negative. There's little sign at the moment of any of these sort of higher wage demands leading into second round effects that would affect core inflation. So I think the bank is right at this point to look through this.
Nicky, we've had about 475 basis points of interest rate increases since November 2021. Do you think they've been impactful?
Oh, absolutely. Certainly, I think every bank will say they have been. We are seeing slow demand for credit coming through. So that means the monetary policy transmission mechanism is working. You've upped interest rates, you've raised the cost of borrowing. And so ultimately, certainly households are responding to that. We've seen a consistent and steady slowdown in growth, and credit is still positive, as the governor points out, but the lags are long. We know that you're probably only going to reach the trough in terms of the response to the rise in interest rates and credit demand in the first half of next year. So this weakness will continue and intensify. And then on the company side, there are some distortions. In terms of company credit, there are some distortions. The need to put in alternative energy sources have kept credit demand on the corporate side quite healthy. The need for working capital, given the volatility, given the squeeze on profitability, has also kept, things like overdrafts and so forth pretty healthy. But those are all distortions. They are companies responding really to the structural challenges that make business very difficult and trying to build their own resilience. And that has led to some credit demand. And I suppose that's distorting the picture to some extent. But where you've got households, it's a very clear pattern of slowdown. So I would say it certainly have been effectful. And we know in the lower income categories and your middle income categories that the strain on consumers are considerable. So when they say that monetary policy is restrictive, it undoubtedly is. And you can see that on the stress that is developing, certainly on the lower to middle income groups.
Yeah, and so we continue our conversation around the MPC's decision on interest rates, keeping those unchanged, with Nicky Weimar, Chief Economist at Nedbank, and Arthur Kamp, Chief Economist at Sanlam. Arthur, I wanted to talk about the issue of some of the impediments to the economy on the growth side. The Reserve Bank governor talking about the energy and logistical constraints being binding on economic activity. To what extent are these suffocating our economy? And what are your thoughts about the speed with which we can get through this very concerning period?
Well, there's no doubt, Nomfa, that is obviously impacting GDP. You can put up different estimates for it. It's not the only thing impacting the economy at the moment. One, Nicky's mentioned, monetary policy, impact on credit extension. That's the first thing. You raise interest rates to slow economic activity. The second thing that I think is particularly important as well is the decline in our commodity export prices this year. It's often underappreciated how important commodity export prices are to our economy. When export prices rise, we have a boost to purchasing power. You see that in consumption, and you normally see that filtering through with a lag to fixed investment spending, and that's absent now with a downturn in commodity prices that we've seen this year. And so now you have logistical issues, which is an add-on onto that. So, the problem is also backlogs at ports and all this sort of thing. It can certainly, be resolved over time. But the problem with infrastructure spending is from when you've decided that you have a problem, and quite clearly we're at that point where we know we've got a problem, and you're starting to implement measures to alleviate the situation. Because it's infrastructure, it takes a good few years to get things up and running again. So, and this is why you're seeing it in these fairly low growth forecasts for next year. So I think it is reasonable to assume that quite a bit of electricity comes back online through next year. But given all these logistical constraints overall, you're seeing growth forecasts of little more than 1% for 2024. And not too much better for 2025. And that's, I think the Reserve Bank has quite clearly, through its explanation of where it thinks the potential growth rate in the economy is, illustrates the degree to which our growth is constrained. So, over the medium term, we've got potential growth of not too much more than 1%. And it reflects these constraints. Unfortunately, I think we're starting to see steps. We've seen a significant amount of steps being taken to rectify the situation. But because it's big infrastructure investment, it's going to take a few years to really show up as an increase in the potential growth rate.
Yeah. Nicky, I think Arthur's touched on it, talking about, the commodities coming down in price. And of course, it's been negative on the rand side with a lot of rand weakness. We see markets pricing the rand down. And of course, that makes us vulnerable to having to pay that much more for imports. And I see that the Reserve Bank is expecting that the current account deficit is going to blow out to 3.5% by 2025 from 2% this year.
Yeah, so I think maybe they're thinking there. I mean, I'm guessing, but I think it's fair to assume we are in the middle of a global slowdown. This same cycle that we've been through, where you've had rising inflation, higher interest rates, that has also played out across the globe, and especially in your major economies. And if you think about who are South Africa's major trading partners, it is the Eurozone, it is China. China has its own problems, many of them also structural. And that means that, you just have slower demand for our exports. Then at the same time, of course, that is reflected in lower commodity prices. So that's the one factor coming through that we get for our exports. So exports not doing that well. And then imports, of course, you've got, based on their theory, you've got this very tight conditions in the oil market, and therefore any little shock and you've got a sudden upward movement in oil. And that's certainly how it's played out of late. We had the conflict between Hamas and Israel, and the outcome of that has been that oil prices suddenly shot up. You had Russia and Saudi Arabia extend their production cuts, and again, you had oil prices shooting up. So there is a sensitivity there without a doubt, and it tends to be tending to the upside. That obviously we net importers of oil, and then you've got all the inefficiencies in the system that gets priced in on both sides. And I think that might be the reason also why you have fairly high imports, because you importing solar panels and batteries and inverters and all of those things you need to import in order to deal with the structural issues we have. And so from there, the sharp rise in the current account deficit. And obviously that will have a dampening impact on the currency, and directly sort of put a weaker bias into it. But it also depends on what's been priced in already. When you look at a currency, it's not just what's happening to the current account, it's also what's been priced in already. And a lot of weakness, I certainly think, on the growth front and on the current account has already been priced in.
All right, I'm in conversation with Nicky Weimar, Chief Economist at Nedbank, and Arthur Kamp, Chief Economist at Sanlam Investments. Arthur, I wanted to ask you, what does your crystal ball tell you about the interest rate trajectory for next year, as well as the inflation trajectory? Obviously, both are related. Do you expect the Reserve Bank to start cutting in the second half or the first half?
But yes, I'm very much in line with the bank. I've got nothing more exciting to say than what the bank has at this point. If you look at the average headline inflation rate for next year of 5%, I'm not far from that. 4.5 the year after. It's the medium-term forecast that's important. And so that, and normally when inflation has peaked and you go into disinflation, that's normally when the interest rate hiking cycle has peaked. So yeah, I think one has to expect interest rate cuts at some point, provided the inflation forecast pans out as expected. There are two things I think are important here. The one is the Fed. The Fed matters. The last year or two has shown us that. And I think that the Fed is probably going to remain on hold for a fair period before it's satisfied that it can start considering interest rate cuts. In fact, we can't say categorically that the Fed rate cycle has peaked yet. I think that will have an influence, especially through global financial conditions and what happens to the rand. The second thing that is important is inflation expectations. The governor mentioned this again today. They are a little bit higher than where the bank would like them. Bank wants them more in line with the midpoint of the inflation target range, closer to 4.5. So I think that the Reserve Bank will probably wait for those two factors to pan out, which does push us later into next year. And I have interest rate cuts starting in the second half of next year. Looking at the year-end number, I'm not different really or very, very little difference from what the bank's quarterly projection model is indicating. They've got 7.55 the end of next year. I've got 7.5, which is 75 basis points down from where we are. There are risks. The governor has pointed those out, but on the balance of current information, that's what I'm going with.
Yeah. So, Nicky, even though there wasn't a rate hike today, like I said, we've still experienced 475 basis points of rate increases, and a lot of consumers are in pain. Many are not able to pay their loans properly and so on. So in the interim, what does the consumer do in this environment, which is a very tight, a restrictive one, as you said?
Yeah, I think, a lot of banks have made statements to this effect. Phone your bank if you really are struggling the very first thing you do is phone the bank, you might find that they are more than willing to accommodate you. So I think that's the first thing. For those that are finding it very difficult to meet the obligations, the debt obligations, that's the first point. Phone your bank, have a conversation with them, talk about the restructure of your debt. That's the first thing. And then finally, I think from the consumer's perspective, it will be really about cutting back where you can. And that is really what the hike in interest rates are intending to do. It's intending to slow things down. And it's painful, but it is the one method we know that ultimately works. It slows demand, and therefore it brings pricing discipline back, both on the side of companies and on the side of organized labor. So the best advice for consumers would be as disciplined as you want, as you need to be. Don't overextend yourself, and if you are in trouble, speak to your bank.
All right. Unchanged at 8.25%. I'm in conversation with Nicky Weimar, Chief Economist at Nedbank, and Arthur Kamp, Chief Economist at Sanlam Investments. Arthur, I wanted to ask you a more fiscal question. People have been quite cynical about the South African Treasury going out and borrowing money from the likes of the World Bank. To what extent do you think this does help in their resolve to try and temper their debt profile?
Well, the one thing about lending from the multilateral organizations is it does tend to come at a lower interest rate. So that does help, because our key problem at the moment is that we are issuing debt at higher real interest rates. New debt is being issued at real interest rates that are far higher than real GDP growth. And so, that negative dynamic between interest costs and deficits and debt levels continues to churn in the wrong direction for us. However, in the broad scheme of things, we're not talking about a very large amount of money compared to the total amount of debt that South Africa has. So it's not going to change our debt trajectory. It's not going to make a very big impact on our real overall effective cost of borrowing. And so ultimately, this does come down to one thing, and that is we do need fiscal consolidation. We do need to improve that primary budget balance sufficiently so that we can start to talk about stabilizing the debt ratio. But of course, it's very difficult to do in South Africa's case. The expenditure demands, because of our poor socioeconomic conditions, are very large. And so, yes, on margin, it does help a little bit, but really it's not going to change overall fiscal dynamics. For that, we really need to raise the growth rate of the economy, and cut back on particularly consumption spending. I think that's particularly important, and raise our capex spending, which helps lift the overall potential growth of the economy.
Yeah. Nicky, one of the things that chokes South Africa's economy is crime. I saw that the World Bank came out with a report suggesting that crime cost the economy 700 million rand, or a lot of money per annum. Those resources could be invested in other more economic activity-related things that could create jobs and so on and so forth. But because of crime, that suffocates us.
Oh, absolutely. So I think that comes back. If you look at some of the comments that have come out of Harvard's Growth Lab, the work done by Professor Hausman, it also shows that really one of the key factors holding us back is a lack of state capacity, and that manifests in different places. And among other, one of those places where it obviously manifests is our inability to enforce law and order. And when you don't have accountability, and that only comes through enforcement, you do tend to have a situation where crime tends to run amok. And I think the World Bank's estimate is, I also speak under correction, but I think they said it reduced GDP overall by 10%. So we could have been 10% larger over the past decade if we did not have this explosion in crime. And I think what adds to it and makes it, especially for the financial sector, it's a big burden, it's an enormous challenge, because ultimately what we need to do is we've got a situation where we've got a fairly sophisticated financial sector, but we have very poor levels of law enforcement. And that's usually the environment in which you have, certain financial fraud, money laundering, and all of those things tend to fry. So we need to combine forces. We need to see effective cases being built by government and the police, and effective prosecutions being sent through. Until that, it continues to redirect resources to what is really an ineffective and inefficient outcome. It's not like it's adding to productive capacity. It's not like it is creating jobs as a result of that. So that's the problem, I think, with all of these challenges we face.
Yeah. Nicky and Arthur, thank you so much for your time and your insights following the MPC's decision there. I was joined in conversation by Nicky Weimar, Chief Economist at Nedbank, and Arthur Kamp, Chief Economist at Sanlam Investments. The Reserve Bank Governor Lesitsha Kganyago saying while rates remain unchanged, the bank will remain vigilant and will be available to do whatever it takes to deal with any risks that may materialize. Well, that's a wrap for this special edition of the MPC broadcast.